Welcome to LaunchBase, a fast-paced podcast exploring the latest in tech funding and product launches. In under 30 minutes, we break down key trends, interview industry leaders, and uncover what's driving the next wave of innovation. And now your host, John Radford.
Welcome back to another episode of LaunchBase. This is the podcast that dives into all things tech in under 30 minutes. I'm your host, John Radford, and each week I chat with individuals shaping the tech landscape. So today I am excited to be joined by Kiran Mehta. Kiran is a former venture capitalist turned advisor to founders. So his experience sits on both sides of the investment table, and Kiran brings invaluable insight on what makes a startup successful and how the funding landscape works and is shifting. So in this episode, we're going to dive into Kiran's journey, the mistakes he sees founders make, how the fundraising landscape differs between London and the north of England, and most common misconceptions that people have when working with VCs. So, Kiran, thank you for joining us.
Thank you for having us.
So how was that intro? Perhaps you could sort of give us a little bit more of a background on yourself, fill in some blanks and talk about where you've, your journey so far, where you've come from, what you've done, and, what you're up to at the moment.
Yeah, absolutely. So I spent 7 years in various investment roles, the last 4 of which was focused on working with high growth technology businesses, principally B2B SaaS, and in the main in the north of England. So that was an interesting journey, invested across kind of pre-seed, seed, and a couple of Series A rounds. And then one of the things that I discovered as part of my time as an investor was I really enjoyed the earlier stage. And the reason I enjoyed the earlier stage is because that's typically when an investor can be the most active in terms of kind of helping, supporting founders with plenty of kind of weird and wonderful advice. I guess there's a lot of things that VCs and non-execs see across multiple businesses, and you've got that external context. And then obviously kind of bringing that together with the work that the founders are doing day to day. So enjoyed kind of more of the being in and around the business than necessarily the doing due diligence, writing investment papers, cutting checks, which might seem strange to some people because everyone thinks VC is the best role in the world. But yeah, for me, there was always something missing. I wanted to be more on that kind of building, operating side. I guess the highs of being founder, being company side are higher, and the lows are definitely lower.
Yeah.
But yeah, that was what I wanted to do long term. So took the plunge at the back end of last year to leave my role as a VC investor. And then since the start of this year, I've been working with founders in advisory roles, kind of fractional COO, CFO work would probably be the easiest way of thinking about it. But the kind of problem statement I always say to people is, do you get value from your non-execs? And they usually say, yeah, I do. Okay, which bits are working? The bits that are working are they've got the external context, they've seen lots of things before, they've seen that next stage of growth, so they can ask all the right questions and make plenty of suggestions. And say, okay, and which bits are not working? Well, they give me a long list of things to do after a board meeting. I've already got 50 other things to do. I don't have the time, I don't have the capacity. Sometimes it's not my skill set. And then obviously the sell is, wouldn't it be great if somebody could do a little bit of both? So that's kind of where my role comes in. So I've got 4 active clients at the moment that majority fit into that camp. And then equally, I do a little bit of advisory work with a local accelerator as well.
Great. Cool. Okay. So I want to go back to front, if that's all right. And we'll talk about the sort of the time at VC, and then we'll move forward into kind of present day and what you're seeing in the startup world. So, on the VC side, so you mentioned that it was kind of B2B SaaS. I'm seeing this a lot with VCs, this tendency to sort of generally B2B. Is that where VCs are more comfortable?
Yeah, I think the big chunk of VCs are more comfortable on the B2B side. And I guess I caveat that with, obviously, that was the world that I was in, so my network is a little bit more skewed to that. So maybe there's a little bit of an echo chamber there. But yeah, the fund that I work with, there was looking at some selective B2C, but more sort of Series A onwards, where you've actually got some tangible metrics. I think the pre-seed and the seed stage of the investing space, it's really, really difficult to do that in B2C unless you've got, really big fund and a lot of diversification. And I think if you look at the kind of bigger outcomes in the UK, B2C is definitely harder. You're bigger. I know you've always got bigger exits out in the US anyway, but in general, the B2C market is not necessarily dominated by UK companies. So yeah, I do think it's a challenge. I think part of it is people stick with what they know as well. And a lot of investors have got more of a background that does go into that kind of B2B space. So yes,
it does feel less risky, and you can kind of, it's more quantifiable as well, isn't it? In terms of kind of the sales of it and like the metrics. So you mentioned the metrics and that sort of thing. With B2B, you can have clients, you've got metrics, you've got things that you can actually demonstrate and show.
Yeah, it's interesting, isn't it? Every pitch deck you see has got that classic hockey stick in, but you think about a B2B software business, it's hockey stick compared to a B2C. Actually, it'll be a lot more gradual on that B2B rise. So every kind of 12, 24 months, you've got that check-in to say, is this working? Is it not? And then usually there's obviously multiple fundraising rounds that kind of fall within it, that sort of go, no-go gate again. But B2C is almost just flat forever. And then your hockey stick, it's almost like a straight acceleration up. So the rewards are definitely bigger if you can get it right, but it's not as much of a relaxing investment journey on the business.
Yeah, no, we'll leave that to the Yanks. So in terms of kind of that kind of seed to Series A, let's say, if I'm a typical founder, what have I got at this stage, and what would a VC look for at that stage? What kind of metrics? What do I need to show to maximize my chances?
This is a good question, I guess, and it depends a little bit in terms of who you ask and what their focus is. But if I think of like the majority of UK-based investors, and I'll sort of take it back from Series A backwards because that probably makes some more sense. But for B2B software businesses looking to raise a Series A, it's still that minimum £1 million ARR, 100% year-on-year growth, and probably some understanding, even if not completely granular, on your customer acquisition costs. And then you're really backing that thesis of if an investor's pouring in 3, 4, 5 million quid into the top of the machine, you should be able to tell them with some degree of certainty where you're going to deploy that, which channels are working, and how long you think that ROI will be. You kind of move one round earlier than that, and you think about that seed check. So for me, probably $500,000 to $2 million typical investment check. Usually businesses that have got revenue, but probably quite early revenue, and you've got a product, you've shipped a product. Your investor might be able to do 2 or 3 quick customer calls to get a feeling for what's the value proposition, why are people buying it. But at that point, you probably don't really understand what's working on your go-to-market strategy. A lot of it will be founder-led sales, and even if it's businesses that long-term want to be product-led, that's probably not the route that you've took thus far. So again, your seed check, in my mind, if you kind of what you've got as Series A, what you've got as seed and what you're trying to get to for Series A, is really raising that capital to invest into the go-to-market that you think is going to be the long-term solution, so that at your Series A, you can kind of tick that box as well. And then the one that's probably most interesting right now is that pre-seed market, because I think historically pre-seed has equaled pre-revenue. Yeah. Whether that is actually what's happening or not right now is a different question.
And what do you mean by that?
I think even at pre-seed, I'm seeing a lot of investors that want to see some commercial traction.
Really?
So not necessarily sales, letters of intent, or you've got your first partnership deal, or you've got some pilots and you can quantify what that land and expand strategy might be. Yeah. I mean, it's not every investor and it's not for every deal, right? If you've sold 3 businesses before and you're kind of typical
backable
founder, you're fine. But actually, for 95, 99% of the market that's first-time founders, pre-seed is just so difficult right now.
Yeah. And why do you say right now? What's changed?
Interest rates have obviously gone up.
So just belt tightening in general, then people just cautious.
Well, not necessarily cautious investors, I guess. Well, it depends what you define as an investor. Most people think in the VC space as the investors as the ones that are managing the VC fund. I think the challenge here is actually one level up, that founders don't often see this, but the VCs are out there raising funds as well.
They've got to get their own money. Yeah. They're just managing capital.
Yeah, agreed. And if you think that kind of medium venture fund in the UK, I think returns 1.7 times in 7 years. Right now, if you put your cash in a high interest HSBC account, you probably won't be far off 1.7 times without taking any risk. So yeah, that's the kind of trade-off that the LPs are making at the moment.
Okay. And so in that pre-seeds, just to go back, what sort of check sizes are people looking to do? And is that not the sort of the SEIS compliance stuff? And, is there not kind of incentives there to help people?
Yeah, I guess it does depend on what the size of the check is. Yeah, anything from sort of 200 grand to probably getting on for $1 million. I'd say $1 million is quite a big pre-seed in the UK, again, for your average business. So yeah, the SEIS side of that helps. I think the SEIS funds, from what I'm seeing in the market, are still deploying relatively quickly. But there's a lot of businesses that can't get all the way through to that seed round with just 250k of cash. If you think your seed investors are looking for businesses that are post-revenue, and at the moment, I think if you've got 250k plus ARR, you're into that kind of seed window. Obviously, everything else has got to stack up, but I think the business is sort of pre 250 are finding it a little bit harder. So kind of 250k SEIS check get you to build a product, ship a product, have 1 or 2 false starts, which will always happen in an early stage business, potentially a bit of a pivot, and 250 grand of revenue. It probably won't. I think you need, whether it be one round or multiple rounds, you probably need somewhere between 500k and £1 million to get to the point where you can be seed fundable. So SEIS helps, it helps a lot, but I don't think it gets a lot of businesses all the way there. And then you end up in a bit of a kind of valley of death where most pre-seed funds are SEIS. Your SEIS is gone, but your EIS and your seed funds are not really getting involved until, when that business is a little bit further down the line.
Okay. And so talking about the product side of things and on that kind of pre-seed stage, because you mentioned about building a product, have people got anything at that stage? Have they maybe got like a no-code thing, or, where? Because I don't mind a bit of no-code, but there definitely is an inflection point where kind of that's no longer a scalable or long-term solution for a business. And where are you seeing this tipping point, and where are people actually building something, should we say, proper, for want of a better word?
Yeah, good question. So I was chatting to a founder a couple of months back, and he was talking about one of the quite active pre-seed funds. And they said to me, great. So this was a slightly different business. So it was more tech-enabled services that was trying to move towards full SaaS. And they said, we can't invest without an MVP. So he spent 20 grand and got an MVP built within 7 days. So you kind of look at it and think, that's not really the way in which it's supposed to work. And I guess the majority of seed investors, especially your institutional pre-seed investors, they're not necessarily got a tech background. So it always blows my mind how little tech kind of, not necessarily due diligence, but even just probing, understanding, getting under the bonnet is actually done by a lot of investors. I think, in its simplest terms at pre-seed, you've probably got to at least have something that a customer could buy, whether that is multi-tenanted and actually, and it's scalable and you can kind of ride that wave for the next 5 years or not is a very different question. But can you, if someone says, yes, I want it, can you at least sell them an instance of that? And then obviously post that round, you've then got to think about kind of longer term scalability.
Yeah. So then the other question I had then is, because I know I've an old client of mine, Toggle AI, which is like an investment platform, they've done seed without any tech due diligence whatsoever. They've raised some, they're Series B now, but like even at that kind of seed round, there was no tech due deal done whatsoever. But if I am reasonably technical or sort of semi-technical as a founder, and I know I build something scrappy here, but I know that if we have ambitions to scale, this is going to need to be rebuilt, and like it's going to be reasonably expensive to do so. How do investors feel about coming to me and saying, like, a large chunk of the money that you're going to give me is going to go into actually rebuilding this thing?
I think a lot of it goes back to commercial traction. So like I've got a client that I'm working with at the moment that's in the midst of a raise, and they've got customers knocking on the door, like genuinely will sign pre-contracts for the product, and then they're going to investors to say, we need just shy of £1 million to actually build this out. On one hand, that is a really good investment thesis, but there is still that nervousness of, like you say, out of that £1 million, 800 of it's going to go into tech. But they have got some very, very strong testimonials. They've got customers that will jump on calls with potential investors.
So they've got that market pull.
Yeah, to say I do need it. And I think that's a lot easier. If you're trying to raise a seed round, like I said, £1 million and 800, 900 grand of that's going on tech, and you've not yet got any market adoption, that's actually quite hard, because you could get to the end of the round, you could have all the tech built out, but you might not then have the validation for the next round. So they kind of go hand in hand. But I think in this market right now, which is obviously really difficult to raise funds, the more you can do to prove out the commercial need before big investment into tech is ideal. I've seen a lot of businesses where that ends up becoming a big part of their Series A round, where the tech, again, it's maybe not an MVP that's got them to that point, but they've got something that's not particularly scalable over the long term. And at that point, let's say the numbers are still the same. Let's say it takes you, just shy of £1 million to re-platform. That's easier if you're raising 5 because you've got commercial traction. So it's always a bit of chicken and egg, isn't it?
Yeah, absolutely. So I'm going to slowly segue back to what you're doing at the moment. And you mentioned, you're keen to get, in at the sort of ground floor, as it were, and sort of help people from, let's go right back to the start and then talk about how, if I'm an ambitious founder, What do you advise me? Because I know you're probably not going to be helping people from day one. They're going to have something. So we'll get to when you kind of come in and when you advise. But like, let's talk about if you were going to build a SaaS, B2B SaaS startup tomorrow, how would you go about building it?
That's a great question.
There's tons of ways of doing it. I'm just, because there's no right or wrong answer, by the way, because there's tons of different ways, because you can build one that's kind of revenue generating from day one. And it's not a business that someone's going to invest in, but it's going to be a lifestyle business and whatnot. So I appreciate there's different answers to this. It's just curious and just to see how you would go about it.
Yeah. So I think I premise this with, I guess I've got that bias towards seeing how many founders are really struggling to raise, both in that kind of final part of being a VC and then a lot of the businesses that I meet now. So I would probably look at how do I get something that's sellable early doors. And I do think there's a massive gap for tech-enabled services. I equally think even some of the successful software businesses will be more valuable if they were tech-enabled services. And by that, I mean your interface with the customer, they've got a relationship manager, they've got a kind of person that they interface with, but actually the tech is doing a lot of the hard work under the bonnet. And then if I was going to set off on building a business, I'd try and sell something that's not necessarily scalable on day one, build more and more functionality back into the product. I think at some point you've then got that inflection point that says, is there either a complete change to being completely software focused, or is there a sort of separation where you've got kind of white glove solution for some clients and then you've got more of a hands off to the other. But yeah, for me, I would be kind of hyper focused on trying to get revenue as early as possible. You see a lot of businesses that go out and they do focus groups and they interview customers and they get loads of great testimonials where customers say, yeah, I'd buy this, because the cost of saying, yes, I'd buy this is obviously very, very low. But then actually going through converting, onboarding, unplugging your current system, that kind of barrier to entry is a lot higher than a lot of us often think.
Yeah, true validation comes in the form of entering credit card details, right?
Yeah. Agreed.
Yeah. Okay, cool. So let's move it forward a little bit to what you're doing at the moment. And I just want to talk a little bit about kind of founders themselves. And, because you've worked with lots of founders, some successful, perhaps some not successful, or you've seen some that you would have invested in and seen some that you have not invested in. Give me some of the mistakes that founders make, and give me some of the things that they do well and some of the traits that you see, some common traits that you see from a successful founder.
Yeah, I think there's a lot that founders do well. I think first and foremost, just being a founder, right?
Yeah, absolutely. Yeah,
I've made the change I have because I want to work company side, but my kind of risk tolerance to go off and set something up on my own, and my kind of vision and kind of forward looking on what a market could look like, that's definitely not my skill set. So yeah, I think that kind of intrinsic belief that a particular market or sector can operate massively differently than the way it does today is obviously huge. And I think sometimes the vision kind of gets lost I'm guilty of this a little bit, of kind of, everyone's got a good vision, but it's the execution that matters. I think since I've been doing a bit more stuff company side, actually, I don't think that's true. I think there's a lot of people out there that are trying to build stuff that's incrementally better than what we've got right now. And there's a very small subsection that are looking at doing something absolutely game changing. Sure. So I think that's one of them. The founders that I work with that have done really well, they're insanely good at hiring. If you think about that kind of inflection point as a business, you can be the best doer in the world, but there'll come a point where, you can close a sale a day and actually that won't make a difference to your numbers because you've got a sales team of 10. You can bash out the best code possible, but again, you've got 20 developers. So yeah, hiring well is a big thing that I tend to look for in the founders that I work with. And equally, obviously, I've seen that in many cases go the opposite way as well. Yeah, they'd probably be the big.
Yeah, and so I think that's a theme that because I sell myself, and the thing that I see quite a lot with talking to people like yourselves and other VCs and whatnot is kind of that ability to sell. And that to me goes hand in hand with the hiring, because you've got to sell your vision, you've got to sell yourself, you've got to sell the company to some of these key hires that you have from, in the early days, right?
Yeah, absolutely. And I think it's sort of almost seen as easy, and it's just really not easy, especially when you think about the varying cultures in startups. Like one of the businesses that I work with at the moment, they're a completely remote first business, and actually hiring the right talent is super difficult there because there's a lot of freedom, there's a lot of autonomy, and you need people that are really self-starters. And the founder's done an amazing job of doing that. It takes them a little bit longer to get a role filled because there's a really small subsection that they're looking for. But yeah, that's like a classic example of a business that's done it really, really well.
Yeah, that's an interesting one with the remote first versus kind of the office thing. And I think if you have that vision, I'm a fan of kind of the remote thing because it does open up a big talent pool potentially. But like you say, it is harder to kind of create that culture, and you might need kind of more of the self-starters, the people who've kind of a little bit more experience. So they might potentially cost you a tiny bit more because they've been through it.
Yeah, it's kind of weird. You've almost got like a job description that's kind of half what are they doing and half could they be a founder themselves in the future. I think that's pretty much, we've never kind of sat down and wrote that down on a piece of paper, but that's ultimately been the type of people that we've ended up recruiting.
Well, you want the ones who maybe could be the founder, but just missing something, so then they don't become a founder, so they kind of stay with you, I guess, or maybe not. You can't expect people to stay with you forever, I guess. And so let's talk about what you're doing at the moment and how you're helping founders and what it is that you're bringing to the table now for founders.
Yeah, so it's definitely a varied role, and like I say, that kind of sort of executive, non-exec that kind of comes in and finds the problems and then helps to solve them is definitely the easiest way of thinking about it. I think there's a big gap in startups at the moment in terms of strategic finance support, and it's definitely not needed on a full-time basis. But I meet a lot of businesses where they've got an outsourced FD that is actually a very expensive bookkeeper stroke financial controller, and they don't necessarily have that B2B SaaS experience. Like the majority of good finance directors that have got B2B SaaS experience are full-time working for Series A plus businesses.
Yeah.
And I think there's a big gap at seed. And I think I think that's quite an important piece of how do you actually translate what the numbers are telling you to strategy? Because, more often than not, the founders are not necessarily kind of commercial numbers financey focused. So there's been a lot of work that we've been doing there, and that's not necessarily just about, we need to grow revenue or we need to take costs out, right? That's the most basic maths anybody can ever do. But it's more about who are our customers, who's spending more, who's upselling, what does an ideal customer look like? Actually, how are we servicing those customers? Have we got a model where we pricing it like it's self-serve SaaS, but then we're actually doing quite a big hand-holding journey at the start, so our unit economics doesn't work out for a subsection of customers. So actually, a lot of pushback you'll get will be, I get is about, can we afford this right now? It should, in theory, lead to either more revenue or a better quality of revenue by really understanding who you should be targeting.
Yeah.
So that's kind of one side of it. And then others have been, how do you kind of go from that startup, everyone can get in a room, everyone knows what's going on, kind of unorganized chaos, but it works, to a scale up without losing part of that culture? So how do you put in more KPIs, more OKRs? How do you actually think about, starting to set up one-to-ones and just getting to the point where you can at least tell your investors for the next round that you've got a system where you can ingest new people into that. And you've got playbooks for hiring dev. Same on the sales front. You don't need to hire an 80K salesperson for the second, third and fourth roles, because we've started to get a bit of a strategy as to mapping out that whole customer journey and who can do different things at different times. So there's a lot in there. It's like I say, it's really varied and it doesn't fit into any one of the kind of 3 or 4 defined boxes, but a really good generalist that's kind of seeing businesses scale and what works and what doesn't is the thing that I've been pitching.
Wicked. That sounds awesome, Kiran. So I want to talk about that kind of you mentioned about the unit economics of, like, say you're a wannabe self-serve SaaS, but you've got tons of onboarding at the start. How do you address that? I'm asking also from a selfish position because we've built an in-house product that's semi kind of grappling with that at the moment, and we're wondering how to kind of transition that.
Yeah, I think the biggest thing that I have to stress to a lot of my clients is employee time is not sunk costs. You can't say like, oh, well, depending on what the team is, but like if you've got a marketing team that's focused on brand build, then I sort of go, okay, that's probably not going into your unit economics. That is longer term. Yeah, it's not kind of direct cost. But if you've got a customer success team or an onboarding team that's actually spending 10 hours onboarding stuff, that absolutely needs to be captured in your customer acquisition cost. And you look at what that does to your CAC to LTV. I've got some businesses that say, oh, it's great, we've got a 3-month payback period. You factor in customer success and actually they've got a 24-month payback period, and that's a lot more challenging. So that's one component of it. I think equally, you've got to be willing to charge for the services that you're delivering. I think in that really early stage kind of startup piece, you just do whatever you can to get revenue, and that is 100% the right way to do it. But then how many times do I see this? Probably the business that's furthest along that I'm working with that's just on the cusp of raising a Series A. Even now, it's taken like the last 3 to 6 months for those guys to say, there's no way that we're going to continue to service every customer that wants to work with us. There are some customers that are just a pain and they will just drain resource. And we're big enough now that actually, if we say no to that 2% of customers, we might free up 50% of our customer success team's time.
Absolutely. Yeah.
And, that goes the other way too. If someone wants, to have a handheld kind of white glove service, that's fine as long as they're willing to pay for it.
You've got to pay for it.
So some of it just takes time, right? Because I would absolutely not advocate to anyone that's sub like a couple of $100,000 of revenue to turn down any customers, because equally you just need that data and that feedback loop there. But I think there is that switch that comes, probably in and around sort of 500,000 plus for a lot of businesses, where you've got to be willing to say, we don't want to service every customer anymore. We're just focused on our ICP. And our ICP is either people that will pay for services or that will just buy a self-serve SaaS product and then will not swamp us with a million change requests.
Yeah, it's hard in the early days though, isn't it?
Yeah, agreed. And it's very much that kind of, it's getting that balance right between doing stuff in the early days that's not scalable, but then equally having some very, very robust conversations, because it's hard to say to a customer, your first customer that might have been the biggest pain in the ass, and he or she's been that for the best reasons possible, and you've refined everything about what you do and your product as a result of that. And then a year later, you go to, you've got X amount of time, you've got 30 minutes a month, and anything on top of that we're going to charge for. But you absolutely do have to do it, otherwise it just doesn't scale.
Yeah, and actually there is such a thing as a bad deal, and like you say, it can sink you if you carry on like over servicing people. Like you say, it's not scalable and whatnot. So yeah, this is some really interesting chats, Kiran. I want you to be able to plug your services a little bit more before we wrap up here. How can people get in touch with you if they need help with these kind of the go-to-market, the COO fractional stuff that you're offering?
LinkedIn's definitely the best way. Just drop me a message. Yeah, that's the easiest communication channel. I will say I am super swamped at the moment, and I'm not just doing that classic thing that consultants do to say they've not got a lot of capacity. But right now, I'm not taking on any more ongoing work. I am selectively looking at a few interesting projects. But yeah, if you do want to have a chat, drop me a message.
Amazing, and I love that. That was the Hard Rock Cafe's thing that they made people queue outside when they launched in London. They made people queue outside, but there was an empty restaurant inside, but made people queue outside. But yeah, no, Kiran, clearly you're adding a lot of value. So yeah, I totally see that you would be swamped. But thank you for your time, mate. I really enjoyed chatting with you guys. If you want to drop Kiran a message, he's on LinkedIn. It's the best place to get in touch with him. And yeah, stay tuned for the next episode, guys, where we'll bring you more tech insights and actionable advice on how to scale your business. Kiran, thanks for your time, buddy.
Awesome. Enjoyed it. Thanks, John.
Cheers, mate. Bye-bye.
Thanks for tuning in to LaunchBase. If you enjoyed this episode, don't forget to subscribe and share. Stay tuned for more insights on tech, funding, and product launches. See you next time.